Welcome back to Management 720. We're on the final chapter, so let's get started with Chapter 12. So if we're on the agenda for Chapter 12, this is going to be the capital budgeting chapter. And just to kind of refresh ourselves where we are in the grand scheme of things, well, we're on the last chapter. First 4 chapters, short-term decision-making, contribution margin. Middle 4 chapters were costing and pricing, basically dealing with indirect costs. And the last 4 chapters, long-term decision-making. We looked at budgets and what happens when budgets, we actual results don't equal the budget. That's the variance. We looked at some information about various long-term decision-making with business segments. And our last long-term topic is capital budgeting. Let's go ahead and get into it. So capital budgeting, most of the time is dealing with long-term assets, but that's not necessarily the only thing it can be. It can be for projects. It can be for joint ventures. It can be any sort of long-term project requiring sort of a large cash outlay. And while there are other assets that the company deals with, those are day-to-day assets, typically inventory and that sort of thing. Long-term investments have a particular thing in that there is supposed to be some sort of return over many years with a large cash outlay up front. Now, that's why when we talk about capital budgeting, it is typically projects who are greater than a year in duration, and it can be any sort of thing, but they're typically strategic investments. What are their commonalities? Well, there's an initial cash expenditure. We don't call it an expense. Remember, an expense is anything that directly supports revenue generation, but it's some outlay of cash. And the idea is that you're projecting that it'll generate future cash flows. So a lot is dependent upon your ability to accurately project these future cash flows. And cash flows can be both in and out, right? You could say this project's going to generate some revenue, additional revenue. It's also going to generate some additional expenses. So you want to look at those both cash receipts and those cash expenditures. And not always, but sometimes at the end of a project, there is, now this is the first time I've seen a textbook use this phrase, disinvestment. Typically, we talk about the salvage value. So if you buy a piece of equipment, you're going to say this piece of equipment is going to make us more efficient and more effective. It's going to generate however much more revenue over time. And at the end, we're not going to run it into the ground. We're going to say, okay, we'll buy this piece of equipment, we'll run it for 10 years, and then we'll sell it for whatever the salvage or the disposal value is. So that period of disinvestment, we also have to take into account because that's a little bit of cash that's coming in at the end of the project as well. Also, when we talk about working capital, sometimes when you have a joint venture or some other sort of project besides just a piece of equipment, you tie up some of your working capital while you're running this project. Maybe it's you have to purchase inventories, and then at the end of the project, you can sell off all those inventories. But those are some additional, investments and returns of investment at the end. What are the characteristics? Typically, we're going to be using time value of money, and we'll talk about that in just a second. It's basically the effect of interest on longer term projects. We're going to have a number you can see over on Learning Objective 2 and Learning Objective 3. We've got a bunch of different things. Now, these are different ways of analyzing capital budget projects. And some of them are going to be simpler ones that we would use for screening, meaning let's say we've got 10 projects and we want to narrow them down to 3 projects. Well, we would use the simpler screening models to get them down to the 3. And then on the last 3, we would maybe do more detail analysis. What is the time horizon? Long-range planning, obviously, but it's situational to the type of company that you're working on. Maybe, if you're a clothing company, maybe long-term horizon is just 5 years, but if you're a car manufacturer, what you're investing is, typically a car model lasts for, 10, 15 years. And also at the end of any project, if it's gone well, you would have a post-project audit. And if you haven't heard this term before, if the project didn't go well, we'd have a post-mortem. So after the death of the project, we would say what went wrong. But you do those things with the idea for continuous improvement. So nothing is wrong with your video. I'm actually doing these out of order. Well, I'm doing out of order of this textbook. I have no idea. And there's been some questionable decisions in the making of this textbook. But why would we do the more complex version, then do the easier version, when in fact, in real life, we would start with the easier capital budgeting modules as a screening mechanism to narrow it down to the big ones. Plus, typically textbooks have a totally separate section on explaining time value of money. So what I'm going to do is I'm going to do Learning Objective 3 first, which are the couple of simpler screening models, and then work in a Learning Objective 2, which requires an extra, there should actually be an additional learning objective there to explain time value of money, then go into net present value and internal rate of return, which is what NPV and IR are. So here for Learning Objective 3, we just talked about capital budgeting. We're looking at a long-term project with cash outflow at the beginning, an initial investment, and we're wondering whether the cash return. Now you notice I'm constantly saying cash inflow, cash outflow, and for the most part, most of these we're dealing with cash flow. There is one that deals with net income, and that's the accounting rate of return. We'll look at that here in a second. So these two models, the payback period and the accounting rate of return, are doing a quick swipe at the project to see what its benefits are. Now, the interesting thing about these two is that they're so quick that they actually do not get into this time value of money. They do not get into the trying to figure out what is the impact of interest on these various models. They're just a quick initial calculation. So payback period, again, we're focusing on cash flow. And for the most part, whenever I talk about cash flow, we're going to assume that it's equal cash flow over a period of years. If there's unequal, we have to kind of do it by hand and do it sort of one step after another. Payback period, all we're saying is, what is the initial investment? What is the cash flow that we're generating each year? How many years does it take for the cash flow coming in, the cash inflow coming in to equal the cash flow, the cash outflow of the initial investment? So for example, here we've got $100,000 investment with we're projecting 40,000 cash inflow. So all we're saying is, how many years of that 40K does it take to equal the 100K? Well, as you can see, first year we're supposed to get 40K, 80K, and then it's a partial year on the third year. And so by end of year 2, we've already received 80K back of towards our initial investment. And how much is left? Well, we don't need a full year 3. We would say 20K is what we have left. 40K is what we're projected to make in year 3. So 20 divided by 40 is 0.5, total of 2.5 years. And you could have gotten that number just by dividing 100K by 40K, which I realize. Just understand that if we had unequal cash flows over these different years, in other words, if they gave us a table and said, oh, it's 10,000 the first year, it's 60,000 the second year, it's 20,000 the third year, whatever, then this would be more, we'd have to do it more by the charting it out year by year. When it's an equal cash flow, you could probably just divide it directly into it and get the number that you're looking for. On accounting rated return, well, this is going to be the one where we're not talking about cash flow, even though the question may give you cash flow. We're going to be wanting to use the calculation with net income. And net income takes into account the idea of depreciation and the salvage value and that sort of thing. So here, the accounting rate of return is the average annual increase in net income over the initial investment. So how would we get net income? Well, if you were in my regular undergraduate class, I would refer us back to all the time that we spent on creating the cash flow statement. But, we haven't done that recently. Just remember, in the cash flows, or for me to remind you, in the cash flow statement, we started off with net income and added depreciation to get to a cash flow number. We did some other things as well. So this is sort of the reverse. In order to get net income, and if we're given the cash flow number, we subtract depreciation because it's a non-cash expense to get to net income. So if you're given if you're given a question and it gives you cash flow and depreciation, or it gives you the means to calculate depreciation, you have to take the cash flow minus your calculated depreciation. And that's your annual net income. And that would be the increase in net income over the initial investment. For example, if we take the same numbers, 100K investment with 40K annual cash flow, but now we need a few extra bits of information. We need to know enough to figure out depreciation. So here we say, okay, this $100,000 investment has a 5-year useful life, no salvage value. So depreciation is going to be 100K divided by 5, or 20,000 per year. So our net income is going to be 40K minus 20K. Well, in order to keep the payback period and the accounting rate return examples the same, well, we come up with some numbers. Usually I like to have, if you take one number minus another number, it should be a third number. But here, 40K minus 20K is 20K. 20K over 100K is 0.2, or 20% accounting rate of return. So those, I would say payback period is very simple. Accounting rate of return, it has a little bit more sophistication. We could use both or either one to sort of narrow down our choices. And then where would we go? Well, we would go to the net present value and internal rate of return on learning objective 2. But before we do that, we have to understand the time value of money, which is what we're doing next. So before we can actually understand net present value and internal rate of return, we have to understand the time value of money. And this is the impact of interest. And if you were in my undergrad class, I'd spend a whole day actually going over this just to introduce you, because time value of money is one of those things that it never really sinks in the first time around. So the more touches you have on it, the more you will internalize it and understand what's going on. Well, we don't have that amount of time today, so I'm going to do sort of a shortened version of Introduction to Time Value of Money. Now, if you've already been exposed to it in some other class, or just through your own business interests, understand it, well, great. Hopefully I'll maybe be able to tell you one or two little interesting things, but let's try and just give you the very basics of what you need to know, at least for this particular chapter. I'm going to start off with future value. Oops, look at that. I didn't even proofread. I'm going to start off with future value because this is just in time proofreading. Because typically future value, when I do the calculations, are a little bit more intuitive. And so here, what is a future value question? If I invest $1,000 today, how much will I have after 5 years if I invest at a 10% rate? So sometimes people don't know, well, is this a future value question or is this a present value question? Whatever number they give you, or I guess whatever number they're asking you for is the question. In other words, that seems a bit vague, but here in this question, the phrasing indicates the table needed. What is unknown? You see, I did start this off as a what is unknown? The future value, right? In other words, it says, I have $1,000 today, but I don't know how much I'll have in 5 years. The future value is the unknown. What is the known? The present. I have $1,000 today. Yeah, I remember I started this off as a future value, a present value question. So that indicates, well, what is the unknown? The unknown indicates what table you would use. The unknown here in this particular one is future value. Now, if we were to do a simple interest version of calculating this thing, we'd say, okay, 10% times a year times $1,000 is $100 a year times 5 years. Oof. I was really not paying attention. 10% a year times $1,000 is $100 a year times 5 years is $500. That's what we would call the simple interest thing. But time value of money really is a fairly simple concept, and yet it can look daunting at times. And the idea is it's not simple interest, it's compound interest. In other words, the interest earned in the first year and the successive years will be available to earn interest as well. So here, let's take a look at this interest earning interest, which is the meaning of the word compounding. So in year one, I have $1,000 times 10% is $100. So at the end of year one, I have the original $1,000 plus the $100 of interest, or $1,100. At year two, I start off with this $1,100. Over the course of the year, that whole amount earns 10%. And so that's $110 plus the amount that I have in the bank at the beginning, which is $1,100, which equals I would have $1,210 at the end of the year. And at the end of year three, I would start off with the 1210 times 10% is 121. Added back in is 1,331. Now, I didn't do it up through year five, but you would see that once we got to year five, it would be more than 500. Now, in the early stages of compounding, it doesn't look like it's getting you that much more than just simple interest. But once you get into 10 years or 15 years, you'll see that the compound interest is really pulling its weight. It's really doing a big job. And that's why they always say, even if you invest small amounts early in your life, you should do it as best you can, because that compounding over time will really start to build. There is not a future table in the book. We can take a look at this. They do give us to the present value table. Now, when I chart this out here, this looks like, okay, that makes sense, or at least you can see where the number's coming from. And sometimes people are intimidated by the actual present value tables. So if we were to look here, and I just said, well, rather than hand calculating, if I wanted to know what is the number for year four or for year five, how would I be able to do that? Well, if you have a interest calculator, or calculating calculator, you could do that. But I wanted to show you from the table point of view how this number was gotten. Here we go. So even though the future value table is not included in this textbook, which blows my mind, but especially when they're talking about time value of money, here I wanted to show you how do the tables work. So here we hand calculated a bunch of numbers and figured out what the interest that would be earned. But if I said, okay, that's good, but what if I wanted to jump straight to year five and not have to hand calculate each step of the way? Well, let's go over and take a look at this future value table. You can see here is the 10% rate, and these are periods. They call them periods rather than years, because sometimes perhaps interest will compound every month or every quarter, or whatever the compounding period of time is, we call those periods. If it's a year, these are just years. So here, these are years. Now notice the 10% here for 1 year, does that not equal... Does that not equal the 1,100? Now notice this table says the factor of $1. Well, what they mean by that, or what the intent of that is, you can use this factor with any number rather than it be some specific number like $100, $1,000, or $1,200, or you can just take this factor, and whatever your number is, let's say your number is 1,342. Well, you just multiply, this would be the 10% interest earned on that, 1.1 times whatever number you have. So here, 1.1 times 1,000 is $1,100. For year two, 1.21 is this number, right? Year three is 1.331, which is this number. So you can see these are not mysterious numbers pulled out of nowhere. All someone has done is gone through and done the step-by-step calculation of adding 10% interest, 12% interest, 15%. I just use 10% because it's very easy, because to calculate 10%, all you have to do is move one decimal place, right? 10% of this number is 100, 10% of this number is 1,100 or 110, 10% of this number is 121. So all these numbers on this table are generated from very simple equations. They're just doing step by step. So the question is, if I wanted to know how much money I would have received investing at 10% after $1,000 at 10% after 5 years, I would look at 5 years, 10%, And I would see that the number is 1.611. In other words, times 1,000, that would be $1,611, which would be more than it would be more than the 1,500 I'd have if I invested it just at simple interest. So the future value tables, or all of these tables, come from a very simple set of equations. All that someone has done is done the legwork and given you the factors so that you can, rather than having to do it step by step, you can jump directly to the number. So I use the initial example of future value because we can easily understand the idea that future value is adding interest on top of interest. Whereas present value is sort of the opposite. It's, for example here, if I need $10,000 in 5 years, how much do I need to invest now at 10%? Well, it's going the other way. It's basically starting off with these amounts and then taking out the effect of interest, withdrawing in other words, it's the inverse of these numbers. Now, I will show you a little trick here that if you remember, if we just look at these numbers here, the 110, 1210, if we're taking out the effect of interest, aren't we doing the inverse of compounding? In fact, we call this discounting. And if I were to show you, if I were to show you, well, like, where do these numbers come from? How do they come up with the idea that there is a number that is taking out the interest? Well, if I knew the factor for here was 1.331, and I wanted to say, okay, I want $1,331 in 3 years. How much do I need now? Well, I would divide by, instead of multiplying by that 1.331, I would divide by that 1.331, and that would take out the effects of interest. So if I were to look at the present value here of 10%, now if I take, let me see, I need to get if I take 1 divided by 1.1, which is the 1 year factor, what do I get? 0. This number right here, 0.90909, etc. Now remember, the second number was 1,210. So if I do 1 divided by 1.21, what do I get? 826,446, or so this last number's, so you can see that's the 2 year 10%. And if I do, the third number we had was 1,331. If I do 1 divided by 1.331, I get 75131. So you can see I can go from the initial very easy calculations of present value, just show you this, and I can derive all the other numbers on all the tables. And all they are just playing with this idea of adding or subtracting interest. So don't be afraid of these tables, or don't be afraid of what they're telling you, because those numbers come from somewhere. They're just not, it's not like a sine and cosine table. I mean, those do freak me out. So anyway, just realize that whatever these are in these tables, they're really representing either adding interest on top of interest for future value tables, or they're subtracting out the idea of interest being earned by interest from those tables. So here, what is a present value question? And just to point out, accounting is focused on present value, and we'll show here in a second. That's part of the reason why this textbook doesn't have future value, but it's a shame that they want to talk about time value of money without having future value in there. If I need 10,000 in 5 years, how much do I need to invest now? So what is the known? The known is the future value. I know I need 10,000 in 5 years. What I don't know, what the unknown is how much I need today. That's why it's a present value question. So what would I do? I would say present value. I want to know the present value of 10%, 5 periods. 10%, 5 periods. I would use this number, 0.62092, times the 10,000. And so if I wanted to invest $6,209.20 at 10%, in 5 years, the interest on top of interest will make it 10,000. Now I could bring up the future value table and we could figure out what is, 6209.20 times the future value, and we would find that it ends up being equaling $10,000 after 5 years. Okay, so that's fine. That's what present value and that's what future value is. But how are we using it in this capital budgeting context? Well, let's rephrase this question, this present value question, with capital budgeting in mind. If this project is projected to earn $25,000 a year for 5 years, is it worth the $100,000 investment today? So I have converted this in a couple of different ways, but you can see that we now have a couple of different numbers. The $25,000 a year is in the future, but it's not just one time in the future, it's over several years in the future. And what we're trying to do is compare these future cash flows to today's cash flow. So I have both a series of future cash flows and I have a cash flow today. So I have both future and present value cash flows. Now that's why we call it net present value, because what we're trying to do is we're trying to take all those future cash flows and turn them into a present day value and compare them to today's value. In other words, 25,000 over 5 years, if I just took the simple amount, 5 times 25 would be 125. But we can see that present value of 10,000 in 5 years today is not 10,000. $10,000 today, or 10,000 5 years from now, is only $6,000 today. So what is $25,000 5 years from now? What is 25,000 4 years from now, et cetera, today? Does it actually, when we add those up, does it equal the investment? And that's why we call it net, because we're looking at some future cash flows that have been discounted to the present day and comparing them to today's present day cash outflow. And that's what the netting is. We're netting the inflows, the present value of the inflows, with today's outflow and seeing which one is stronger. Okay, so let's go ahead and continue on with this time value of money. So let's take a look again at those two examples. The present value question, if I need 10,000 in 5 years. So if the future value shows us the effect of compound interest, I think I kind of started talking about this. The present value shows us the effect of taking away the compound interest. And that's why we call it discounting. And if you look here, you can see it's called the discount rate. So a lot of what we do in accounting is use present value because we want to know what's today's value, partly for things like capital budgeting. But another reason is when we do bonds and other things that we present value is there's going to be some effect from this, say, financial instrument in the future, but we have to write our financial statements today. So we want to know what the present value of those future transactions are today so that we can put them in today's income statement and today's balance sheet. In the capital budgeting context, so we introduced a couple of other things. We're asking a slightly different question. The first one is talking about a one lump sum, right? This is, I need 10,000 in 5 years. Whereas I'm saying here, this is 25 a year for 5 years. So that means 25,000 on year 1, 25,000 on year 2, et cetera, et cetera. When we have a series of cash flows that are all the same, we call this an annuity. We call this an annuity question. And if you've ever seen on late night TV, J.G. Wentworth, it's your cash, you can have it now. They're just doing these time value of money questions. Next time you see that, sometimes they're singing opera or something like that. Next time, listen to what they're singing. They're saying, is it your money? You can have it now. They're asking, did you get a settlement from some sort of injury case or from some accident or from a hospital? So they're basically saying you have an annuity. You have a certain amount of money being paid out over a certain amount of time. Do you want to know the single value, the present sum value, the present day value? And then what they will end up doing probably is they will select a discount value that makes the number a little smaller, but it's human nature to want all your money now rather than wait for it over time. So they make money on paying you for your annuity with maybe a smaller lump sum today. And all they've done is gone to these discount tables and figure out a number and then undercut it a little bit. So a series of annual payments that we want to discount back to the present so we can compare it to the initial investment. So we have future value and present value, but we also have future value of annuity and present value of annuity. So future and present value are talking about single sums, one time in the future or one time right now. And the annuity is, and it's important to remember when we talk about annuity, it's got to be the same time between each payment. In other words, it can't be one year and then like 3 years later or something like that. It has to be every year or every time period, and it has to be the same amount. Okay, so that is the basics of time value of money, at least for what we need to talk. I know there's probably several questions, but as far as we need to know, we are going to be using present value and present value of annuity to figure out a capital budgeting question. So let's take a look. Now that we understand a little bit about time value of money, we can look at the two different things that the two different capital budgeting models. Now, really, there's just one budget. There's one model. We speak about internal rate of return, but it's a little bit advanced, and the version that we use now is not very helpful. It's not as helpful as the net present value. But let's take a look at the net present value. The capital budgeting context of this project is projected to earn $25,000 a year for 5 years. Is it worth the $100,000 investment today? So normally how we set these things up is we set them up in sort of a year order. So year 0 is what we call the present day or the present value. The initial investment, well, what is the cash flow? It's a cash flow of minus $100,000. And then we say over years 1 through 5, because it's $25,000 a year for 5 years, we can call this a present value annuity. And what is it? Well, here we need to know one more thing, the cost of capital. In other words, we talked a little bit before about the weighted average cost of capital. This is whatever your borrowing costs are or what your expected rate of return is to be. In other words, you need to make at least 10% on whatever you borrow for internally for it to be a good project. So we use this as, we call it the hurdle rate. It has to be at least as good as 10% because, for example, if we borrowed the $100,000 from the bank at a 10% interest rate, well, we need to make at least 10% so we can pay back the loan and the 10% interest. That's the idea of whatever the cost of capital is. So we would go to the table here and we would say, not the present value. The present value is for one sum in the future. Here, we don't have one sum. We have five cash flows, one on year 1, one on year 2, one on year 3, et cetera, et cetera. So I would go to 10% on the present value of annuity chart. I would go down 5 years. It is 379,079. So what I'm going to be doing is multiplying that 25,000 times 37909. Remember, we said 5 years times 25,000 on a nominal base would be 125,000, but on a discount version, that amount of money is only worth 94,770 today. So that would be discounting the 25,000 a year for 5 years back to present day. This is what it's worth today. That 25,000 in year 1, the 25,000 in year 2, all the way up through year 5. If we took all those amounts and we discounted them back today, they would sum up to 94,000. So if we can now compare apples to apples. This is a present day, a present value, and this is a present value, and now we're going to net them. So a minus 100,000, a positive 94,000 says this project wouldn't be worth it. We would lose money by doing this project. So it's important to not just trust your, what you would think your instincts of, oh, it's going to make 125,000 over 5 years. It should cover it. Not necessarily. It depends upon the discount rate and other things as well. Well, let's add one complication to this, because remember when we first talked about projects, we said there's an initial cash outlay, that's this initial investment. There's cash flows that are coming in over time, that's this part. And then sometimes we have remember we used the phrase disinvestment, or we're able to sell off the piece of equipment or whatever, we can get our working capital back. So usually at the end of the project, not usually, sometimes at the end of the project, there is a one-time cash flow that says, okay, you sell off the piece of equipment, or there's some finality to the project that you're closing down the project. And here, what happens if, let's say this project is actually buying a piece of equipment. Let's say we can sell this equipment used at the end of 5 years for $10,000. So we have all the same things. We have year one, the initial cash outflow. Years 1 through 5, the present value of annuity, the cash, that $125,000 discounted back to today is worth $94,000. And then I would again use the present value table, not the present value of annuity, because the $10,000 is only at year 5. It's not at years 1 through 5. At year 5, we are able to sell the used piece of equipment for $10,000. So I would go on the present value of $1 and go 10%, 5 years, 0.62092. And so that would say, okay, even though it's $10,000, that's $10,000 5 years from now. What is $10,000 5 years from now worth today? It's worth this 6209. So here, that would just barely get us. So it technically would be a positive net present value, but are you willing to tie up $100,000 over 5 years to just get less than $1,000? So we'll discuss that here in a second about what are the pros and cons of making a decision about present value. But at least you can see the difference here is this is a definite no. We're losing money. This is a qualified yes, in that we're making a little bit of money. At least we're positive. Now for the internal rate of return, this is the discount rate that makes the cash flows equal to the cash inflows equal to the cash outflows. In other words, if this is the cash outflow and these are the cash inflows, what we're saying is if the net present value is 0, what is that percentage, right? Because whatever that percentage is what the or whatever the discount rate is, that is what the project is earning. Now, if you end up finding that the discount rate, the internal rate of return is 13% and your cost of capital is only 10%, so what you're basically saying is if you discover with the internal rate of return that the project is earning 13% and that makes it break even and you only need to earn 10%, well, then that's a positive. But the way we go about it without the more sophisticated version is we basically have to hunt and peck along the table to figure out what the number is. And I will show you that once we get to the homework. But basically, if the internal rate of return is greater than the cost of capital, then it's a positive investment. It can be sophisticated, but we use a basic table approach. Okay, well, let's continue on. Let's look at some strengths and weaknesses. Oops, just a sec. I didn't change the color on the learning objective. I don't know if you've noticed that. There's been a couple of times where I've forgotten to do it. Okay, so for payback period and accounting rate of return, my voice is very dry today. Payback period and accounting rate of return, both of these are screening measures. They're both simplified. I would say accounting rate of return is a little bit more sophisticated than the payback period. It's quick to calculate. That's a good thing. That's why we'd use it as a screening measure. It does not consider time value of money, and it does not focus on profit. Think about that. When we're calculating the payback period, all we're doing is saying how many years do we pay it back. It doesn't say over the life of the project how much profit would we be generating. And because of that, it does not consider the cash flow after the paid back period has been determined. Accounting rate of return does not consider time value of money either, but it does evaluate profit. But the other thing it doesn't consider is with the accounting rate of returns, if you remember in the equation, it says the average net income, the average increase to net income. So even if the cash flows are maybe uneven or they're more in the beginning than at the end, the accounting rate of return does not evaluate that or does not look at the timing of the cash flows. So that's sort of a con for accounting rate of return. When we talk about net present value, that's the one that we use almost exclusively. We would use one of these other two, typically payback period, because that's an easy one to do to narrow down our choices, and then use net present value. It does consider time value of money. It does consider profit. It also considers the size of the investment, right? We look at the cash outflow versus the cash inflows. So we can say, here's the amount of profit as juxtaposed against the size of the investment. For example, we were looking at only making $979 off a $100,000 investment. We do get that information. What if I had said, it was $979 off of a $5,000 investment? Well, we might have a different opinion. $975 off of $5,000. Well, that's pretty good. Whereas a $979 net present value off a $100,000 project is maybe not as good. Although this is not big for here in the MBA program, it is a big if you're going on, or if you've had a master's in finance, or if you're considering that, understanding that the reinvestment is at the discount rate isn't important, as opposed to the internal rate of return, which assumes the investment rate at the IRR rate, which is its actual return rate. Internal rate of return does consider time value of money and profit. It does not consider the investment side. It has it's a different assumption as far as the reinvestment, and it's a little harder to conceptualize and use. And so typically it's one of those things that we introduce in these sort of textbooks. You might feel, I'm at a master's level, but now we're talking about maybe upper level finance. And so just understanding what it is probably our first step. And then if you go further in any of your finance classes, or you decide to pursue a master's in finance, then you would get a little bit more information about being a little more sophisticated with the internal rate of return. Learning objective 3 is sort of, I don't want to say it's filler. It's interesting information, but there's so much information already going on in this chapter that I'm just going to cover it fairly lightly. Just remember, as I've said before, that whenever we're doing a calculation in accounting, it's just the first step in a business decision. It's the quantitative step, figuring out what the number is. There's a lot of qualitative things that you need to think about when you're making it, especially for a capital budgeting decision. So here are some of the things that go into the qualitative or the judgment part of capital budget decision making, in addition to figuring out the number. So evaluating risk, remember, these are all estimated future cash flows. How good are you at estimating? Here are some things. The initial investment, have we captured it all? We think it's $100,000, but once we start the project, are there, it's like building a house or something. There's always some hidden costs. What is the time horizon? We believe that we know the timing of the cash flows in the future, but did we get them down? Were we a little more conservative, or were we too aggressive? Have we timed those? Have we projected those cash flows accurately? The useful life, how long this piece of equipment or how long this project's going to last, and the salvage values. This whole idea, it's going to be worth $10,000. Do we really know that? Do we have good evidence? Should we be a little more conservative? And the whole idea of assuming this project that there is some customer demand and there is going to be a selling price that we can land on, and that goes into the model. Are those good? Are those accurate? Are those reliable? So just remember, all of this projection is based upon being able to estimate these things in the future. So how would we mitigate some of these risks that we're looking at? Well, we could use a higher discount rate. If we say our cost of capital is 10%, maybe we raise it to 12%. 12% just makes the net present value harder to achieve. And so we would say, okay, if we would break even at, if we show, we would break even at 12%, well, then we have good idea that if our cost of capital really is 10%, that we are giving ourselves a buffer. Perhaps we would change a number of the values from very easily achievable to maybe hard numbers, and compute a range of net present value and say, okay, well, what do we need? We need to, the cash flow is not going to be 25,000. It's going to be 20,000. What would that do to the net present value? And we would look at maybe some sensitivity analysis. So, if you do any sort of quantitative database mining, you'll be able to figure out that sometimes changes in one of the numbers is much more impactful than changes in the other numbers. And so figuring out which number is the most sensitive to change would allow you to also adjust your model. What are some common missteps? Now in the book, they give these as a high-tech example, but I think these are generalizable to all types of business. Investing in unnecessarily or overly complex equipment. Well, obviously this could be high tech, but believe you me, there's a lot of low tech businesses where the bosses want the latest, newest, shiny thing. Oh, let's get this piece of equipment. Let's get this brand new truck. Let's get this new store on Main Street. Rather than at the new mall rather than at a strip mall. In other words, they go for the new shiny thing and they try and justify it. And sometimes justification isn't worth it. You overestimate the cost savings. You underestimate the additional additional sales or the cost savings. Now, these happen. In other words, people sometimes can be too optimistic, and a lot of times, as the accountant or as the business manager, the MBA person, you have to think of yourself as maybe the adult in the room and maybe rein in some of the enthusiasm and say, okay, have we done enough, market research? Have we looked at comparables where we've done it before or other companies have done this same thing before, and what were the outcomes? So especially with capital budgeting, investing in high dollar items or projects, it requires 2 or 3 looks and making sure that you're being, I don't want to have to say be pessimistic, but just be realistic. The last thing I want to talk about is taxes. So with net present value, we make a big deal about, okay, well, net present value or these capital budgeting models take into account the idea of interest. But notice that we don't have a net present value that explicitly takes taxes into account. Well, we need to at least touch base on this, and this is an important topic, although I don't want to get too much into the weeds. Essentially, what we want to focus on is depreciation is a non-cash expense. In other words, it reduces your net income, but it doesn't necessarily reduce your cash. In other words, we're not spending money on depreciation. Remember, depreciation is, we have the initial cash outflow, right? In the year that we buy this $100,000 piece of equipment, we spend all $100,000 in that first year, but we don't take that $100,000 as an expense in the first year. We depreciate it over its useful life. So if it's 5 years, we take $20,000 each year. So obviously there's a cash outflow in the first year. There's $100,000 outflow, but the depreciation is only $20,000. But in the subsequent years, and therefore the subsequent the subsequent income statements, we subtract $20,000 as depreciation, even though we didn't actually spend cash in those years for $20,000. But it does reduce net income, and therefore it reduces taxes. But part of this is realizing this and understanding what is depreciation doing for us. So it reduces net income, which reduces and this is not greater than, this is leading to, reduces net income, which leads to reduces tax expense. Reducing the cash tax expense means increasing cash flow or conserving cash. We didn't actually spend that cash. And so what do we have? We have a calculation called a depreciation tax shield, which is depreciation times the tax rate. So you can look here, we've got 2 different charts, and again, not to go too much in the weeds, we have one here where we've looked at it and it's 0 depreciation. And then once we add in depreciation, what happens? Well, you can see net income goes down. When we look at the same thing, but we look at it from a cash flow point of view, if we don't have depreciation, the net cash flow is almost $20,000. And you notice we spent $10,000 on taxes, whereas here, and you notice it's a 34%. When we add in depreciation, even though we didn't spend any cash on it, it reduces net income, and therefore our income taxes is less. Our income taxes are less. And what does that mean? It means that without depreciation, income taxes would have been $10,200, and our cash flow would have been 19.8. With depreciation, our income taxes are lower and our cash flow is higher. So what is the income tax difference? The 10 versus the 4.586? It's 5,614. What is the difference between the cash flow, the 19,800, and the 25,414? It's 5,614. Well, where do we get that number? If we take the tax rate times the depreciation amount, that is the depreciation tax shield. The 16, now it comes out to a slightly different number because there's some rounding going on in here. Some rounding of there's some decimal places that get rounded off. But you can see that we can project how much cash flow we're going to save because of depreciation, and that's the depreciation tax shield. And so over the life of a project, if we have a project that's being depreciated, it's also conserving some cash for us as well. And so while we may not have a good use for that here, your accountant will have a good use for it. But I want you as MBA students to just understand that there is a positive thing for depreciation. It can conserve cash because it reduces your taxes, but it doesn't reduce your cash outflow. Okay, last thing here is we're going to look at the homework. So here on the homework, we've got 1 on payback period. We've got 1 on accounting return. We have 2 on net present value, 1 without salvage value, a simplified version, and 1 with a little bit more complexity. And then we look at internal rate of return. We look at 1 depreciation tax shield question. And then we look at a comparison of present payback period, accounting return, and net present value. And then we do 1 on the time value of money. To be honest, if I could change something, I'd go back and take out this one, but I see several of you have already done it. And so I'm going to go ahead and explain it because this book hasn't done a great job on some topics, and this is one topic it didn't do a great job, at least on the homework question. It's a little bit strange. Anyway, let's go ahead and take a look at these homework problems. Okay, let's start working through the problems. So question number 8 is our payback period question. So this is what I was saying in the explanation, is that if you just have the same cash flow each year, it's pretty easy. You just divide the cash flow by the total investment, and you can get the payback period. But here, if you have unequal cash flows, you have to start counting it up. So here we have these various cash flows. Let me see. So this is question number 8. We're considering an investment of $71,250, and here are what we think are the cash flows coming in over the years. Now, these are sort of strange numbers. Typically, you either have an investment which is front-loaded to where you get most of your cash back at the beginning, or it takes some time to get going to where it's low in the beginning and ramps. I don't know of many things that go up, then down, then big up, then down. I mean, it goes up, down, up, down, up, down. So I don't, unless this is, let's say this is like an event that happens every 4 years. Let's say you're putting on your little city's Olympics, right? So this may be the Olympic year, and anyway, I don't know what this is showing. So we have year 1, which is 20, and so I'm going to put the number of the year, and this is going to be the cumulative. So this will be the adding it up. So after 1 year, we take in 20, and therefore we have a total of 20. After year 2, we take in 23, so we have a total of 43. And after year 3, we take in 17, and we have a total of 60, right? And year 4, we take in 50. Well, you can see we're not going to make it all the way through year 4, right? In other words, we're at 60 here, and sometime during year 4, we're going to hit 71,250. So how do we figure that out? So what is left over? What's left over is did I add that right? If we take the 71,250 and subtract out the 60 that we've already booked, that would be 11,250. And we divide that by, well, how much are we earning this year? 50,000. So how far into the year do we go? Well, 11,250 divided by 50,000 equals 0.225. So it's going to be 3 years plus 0.225 of the fourth year. So it's going to be 3.2, well, it says 2 decimal points, 0.23. And what do we have? 3.23. Okay, let's take a look at the next one. Number 9, this is going to be accounting rate of return. Remember, in accounting rate of return, we're focused on net income, not cash flow. Remember, it's the increase of net income over the initial investment. So here, they consider purchase and use print costing $36,000. Well, that is the investment. The printing press will generate net cash flow $10,000 a year for 10 years. At the end of the 10 years, will have no salvage value. Cost of capital is 10%. Uses straight line depreciation. Okay, so we need to convert this cash flow of $10,000 into a net income number. And what do? We're going to do cash flow minus depreciation, right? And that's going to be net income. So the cash flow is $10,000. What is the depreciation? The depreciation is going to be, the project costs $36,000 and it's going to be over 10 years. So depreciation is going to be $3,600 a year, or net income is going to be $6,400. And so what do? We take 6,400 divided by the investment, which is 36,000. And that is going to equal equals 0.178 repeating, or 177 repeating. And that's going to be the same as 17.8%, or it looks like they round it up, so equals 18%. So that's the accounting rate of review, rate of return. Let's take a look at number 10. Number 10 is going to be our first net present value. Yes, so without salvage value. It's considering the purchase of a used printing press costing $139,400. The printing press will generate cash flow $62,000 a year for 3 years. At the end of 3 years, the press will have no salvage value. Company cost of capital is 10%. The company uses straight line. A present factor. Okay, so they've given us a small portion of the table. So we want to set this up whenever we're doing this. Year 0 is the initial investment. And in this case, that's going to be minus 139,400. Years 1 through 3 is going to be, it's going to be 10% is our interest rate, and it's going to be period of 3, which is this number here, 2.48685, and we're going to multiply that by the amount of cash we get every year times 62,000. So 62,000 times 2.4685, is that right? It's going to be 154,184.7. There's no salvage value, so it's just these. It's a cash outflow and a cash inflow. So basically what we're saying is 3 years of 62,000, even though if I multiplied it out, That'd be 186, right? 3 times 62 is going to be 186. 186 discounted back to present day is 154. And so the initial cash outlay is 139. Our projected value of our cash inflows over time is going to be the worth 154, the same as being 154,000 today. So if we subtract out the 139,400, that would mean a positive net present value of 14,784.70. They probably want us to round it up to 785. I see that answer is there. So 14. So round it up to 14,785. So that's net present value without salvage value. So let's take a look at net present value with salvage value. Question number 11. And so they've gotten this actually in pretty good order. It may seem like a lot of words, but just recognize that here the initial investment, it's not only cash outlay, but it's tying up working capital. So we would say at year 0, the initial investment is going to be both of these numbers together. So 43,200 and 4,800. I mean, I can eyeball that. That looks like that is 48,000. So the initial outlay is 48,000, and let's see, it is for 4 years, per year for 4 years. So years 1 through 4, the operation is going to be well, they don't give us a table, they just give us the present value and present value annuity. Well, we need the present value of annuity here. I guess I should have said this is the present value of annuity. The present value of annuity is going to be 3.16987 times, well, what is the number? So we've got cash receipts and cash expenditures. So some of these are cash inflows and cash outflows. So what we want is just just one number, which is the difference between those two. So if I say we are bringing in 30,000 a year, but we're also spending 13,200 a year, that means we're netting 16,800 a year. So multiplying these two numbers together, 16,800 times the 3.16987 is going to be 53,255. Well, I guess I should round up 254. Now we have a salvage. Now you see they call it disinvestment. Let's just call it year 4. And because this is a one-time return of capital, in other words, it's not every year over 4 years. It's only at year 4. So we would just use present value. So the present value of these two numbers together, well, first of all, the present value is 0.68301 times, adding these two numbers together, 3,600 plus 4,800 equals 8,400. So multiplying those by the 0.683 equals 5,737 rounded. So 5,737 plus the 53,254 minus the initial cash outlay of 48,000 is going to be 10,991. So the net present value is 10,991. And do we have that number? We do. Okay, so that is, well, I guess we have one more on internal rate of return. And if you remember, I was saying that this can be a sophisticated view of a project, but by the way we do it, we're just going to use what we call the table approach. And I'll show you what I mean by that. So Cass Publishing is considering the purchase of a used printing press costing $90,000, $90,240. The printing press would generate equal net cash flows of 37.5. These strange numbers, right? A year for 3 years. At the end of 3 years, the press would have no salvage value. The company's cost of capital is 10%. The company's okay. So what do we need to do? What we're trying to figure out is if we're getting $37,000 a year for a $90,000 project, what is that multiple? What is that return? So what we do here is say that we take the investment divided by the cash flow, and that's going to be $90,240 over 37. And you'll see why these are such odd numbers here in just a second. And so if I take the 90,240 divided by 37,572, that's going to come out, and we're going to go to a couple of decimal places here. 2.40178. I'll stop there. Now, what we do when we have this number now is we basically say, okay, the company's cost of capital is 10%. Does this project make more or less? Because remember, this number is basically, we're finding the percentage at which the project is a break even. So this is a 3-year project, right? So I'm going to go along the 3-year line. And I'm going to find the number that's closest to this 2,40178. Now, of course, they've chosen numbers that gets us really close to this number, right? So we're saying that the internal rate of return is approximately 12%. 12% is higher than 10%, so this project is positive. In other words, it is break even at 12%. Therefore, at 10%, it's going to be making money. But there are plenty of times when you do these calculations and the number is somewhere in between. And so you have to make sort of a judgment of, well, is it really close to 10 or is it really close to 11 or is it really close to 12, whatever it is. But you can see that's what I'm saying. It's kind of a hodgepodge approach when we just do use the table approach. We calculate the factor, and then we look up and see this number that I calculated as a factor is closest to what percentage on the table. And here it's 12%. So here, 12%. So that's why I say that at this level, net present value is far and away the more informative budgeting model. And internal rate of return gives us some information. I wouldn't say there's no information. It's saying that it's because when I calculate net present value, I calculate what's the additional amount of, how much above break even is it? Well, when I calculate this, I'm giving myself another number. I'm giving myself a number saying, even though our cost of capital is 10%, well, how much percentage is this project generating? It's generating around a 12% level. And so I could use that. Remember I said that we use the payback period and the accounting rate of return to narrow, say 10 projects down to 3. I could run net present value and internal rate of return to give me two numbers. I could say, what is the total return? What's the total positive cash flow? And I could see which one has a higher internal rate of return, which one is so if the next one is generating at 14%, maybe that's a better project or better use of cash than just looking at the net present value. So I'm not saying it doesn't produce any information. It just is usually used not at all, or it's used in conjunction with the net present value, because the net present value typically gives us some actionable information. Okay, let's take a look at the next one. So the next one is, I've forgotten, is going to be, this is the tax shield. So let's take a look at the tax shield. Companies consider investment in equipment costing $36,000 with a 5-year life and no salvage value. they use straight line depreciation subject to 35% tax rate. The expected net cash flow before depreciation tax is projected to be $24,000. Okay, so our depreciation tax shield. So the tax shield. Remember what we're saying with the tax shield. This is how much cash we're going to be conserving over this time because of depreciation. Is the depreciation times the tax rate. Now just recognize this is for 1 year. See, I got a little bit of some on my cuff again. How do I have such dirty cuffs? So what is our depreciation? So depreciation is going to be, well, it's a $36,000 project over 5 years, and that's going to equal $7,200, and the tax rate is 0.35. So 7,200 times 0.35 equals, this is how much cash, in other words, this has reduced our taxes by $25.20 each year. Therefore, we've conserved or not spent that cash. Now, you notice, and they're a little sneaky on this when I was noticing this earlier, you're noticing there is a 25.20, but read the actual question here. Over the life of the project, 25.20 is what we're saving each year, right? So if this was over the life of the project, that's time 5 years, it's going to be $12,600. So this, it's not a wrong number, but that's just the tax shield for 1 year, not the life of the project. Okay, let's see, number 14. We're getting in deep here. So this requires us, now I'm just going to throw out, this is, I would love this type of question, but with some better numbers. You can see the initial investment here is $98,000. What we're doing is basically looking at payback period, accounting rate of return, and the net present value. And what you're going to see is that these give us somewhat different numbers, but the funky numbers that they give us here to where, okay, we're earning the same amount each year. Well, that's fine. This one only goes for 1 year. That seems kind of weird. And this one still earns the same amount of cash flow. It's just divided up over a different period of time. So while we'll go through the motions and calculate each one's, you're going to feel, and I'm going to feel, that the numbers are kind of weird, but I think the process is correct. Process would be, normally you would figure out payback period, accounting rate of return, or one of those two, and then narrow your selection down. You know, this should be like maybe 6 that we narrow down to 2, and then use net present value on the last 2. That would be a better question, in my opinion. But anyway, I'm just trying to show you that this is the typical process. So let's go ahead and take a look. And the fact that these 3 different things can give us 3 different answers. The first one is payback period. And remember, payback period is going to be investment over cash flow. And remember, what we're trying to do here is look at the cash flows, and at what point in time do the cash flows pay back the initial investment, right? So you can see here that to get the 98,000, we're here for the first one, proposal X, we make 98,000 in the first year, right? So if I'm going to put, let's see, I'll put X, Y, and Z. So it takes 2 years for the first one. So this is payback period. And we make 98,000 after 2 years. So again, this is kind of saying that It's kind of weird how they've done it, that it makes it exactly in 2 years for these two. And this one is in 1. So what is the best? Well, X and Y are the same, but Z makes it back in 1 year. So Z is the best here. The next one that we're going to look at is the accounting rate of return. Remember, that is net income over the investment. And so when I look at this, we need to figure out some net income. So we take cash flow, right? Well, I'm saying, first of all, the depreciation is 98,000, at least for the first two. Proposal X and Y is going to be the investment divided by 3 years is going to be a depreciation of 32,000. Again, a strange number. Divided by 3. 667. Now we take, how do we get to net income? We take the cash flow, subtract out depreciation. So this is going to be a subtraction. And so what is the cash flow? Well, remember when we're looking at this, remember one of the things about accounting rate of return is that it does not look at different cash flows over the years. It takes the average. So if I were to look at this and say, what is well, this one's easy. The average cash flow is 49. But looking at this one, the average cash flow is also 49. These 2 years, 98 divided by 2 is 49. So the cash flow for X and Y is 49,000. So when I subtract those out, $49,000 minus the 32,667 is going to be net income of 16,333, and this is for X and Y. And then for Z, the depreciation is not going to be 98 divided by 3. It's going to be 98 divided by 1, right? So for Z, it's going to be depreciation is going to be 98,000 because it's all done in the first year, and there's only one cash flow, 98,000. So this is going to be 0, right? So there is no accounting rate of return. This is a zilch here. And that makes sense because we have a project and we get all our money back the next year. There's no figuring out depreciation. It's as if, because depreciation's normally spread across time. Here, it all happens at once. So again, kind of a strange thing. So net income divided by investment. So this over 98,000 is going to be, for both of these, it's going to be 0.1, how 4 decimal places, 1667. So strangely enough, X, do they have? They do. So this is going to be X and Y. So this is for the accounting rate of return. This is for payback. And now we need to look at net present value, and it says round to whole numbers. So net present value is going to be, oh boy, we got to figure out the two different ones. So this is a bit of a chore because we can figure this one out using present value of annuity because it is it's the same each year. But here we've got to figure out them for each year. Okay, so, and I guess this is a good example of, even though the earlier questions were pretty easy and straightforward, this is typically the work put into figuring out some of these things. There's a lot of little things you've got to make sure you take into account. So for each of these, we've got the initial investment. And so that's going to be, for X, it's going to be 98,000. All three of these are going to be the same for that part. And then we're going to have present value of year 1, 2, and 3. For X, this is X, Y, and Z. Yes, I lived in Commonwealth countries. And then these three will pertain to X. Then we're going to do a present value of annuity of years 1 through 3 for Y. And then there is nothing for, well, I guess there's a present value of 1 year for C. So what we need now is we need the values for these. So let me see if I can bring these up. Okay. So the present value, and let me just double check. It is, cost of capital is 10%, right? Okay. Cost of capital is 10%. So the numbers I'm going to need here for present value 1 year are going to be, let's see, do I have room at the side here to put it? I guess I do. 0.90909. 2 is going to be 0.82645. Year 3 is 0.75131. And the present value of annuity for 3 years is going to be 2.48685. Okay. So we need to do some calculation here. Now, what am I multiplying these by? For here, I am multiplying 0.90909 times 90,000 is going to give me 81818.1, and I will do the same thing over here. 0.90909 times 98,000 is 89090. And then here for the second year, I'm going to be using 8,000, right? So 8,000 times 0.82645 is 6611.6. And then year 3 is 49,000 times 0.75131 is 36,814.2. Add those up in just a second. I'm going to be adding all of these. Let's do the one for this one. So all 3 years together, I don't have to do them individually by year. I can just do the present value of annuity because it's the same cash flow each year. So I'm going to multiply 49,000 times this number, 2.48685. And that's going to come out to 121,855 or 856. Maybe I'm rounding. Figure out that number. Now I have this number. Okay, so the present value of annuity here is 81,818. I'm going to round, plus 6612 plus 36,814 equals 125, minus the initial investment of 98,000 equals 27,244. This one is going to be 121,855 minus the initial investment of 98,000. It's going to be 23,855. And notice here, 89090 minus 98,000. This is actually negative, minus 8,910. And that makes sense because if you have a project that you invested 98,000 and a year later you only get 98,000. Well, we know discounting 98,000 in the future is not the same as 98,000 right now. So if we only get 98,000 back a year from now, we will have lost money. In other words, you could have invested that 98,000 in something else and made more than 98,000 after a year. So this is a loss. This is positive. So what are we saying here? Well, we said on the payback period, Z was the best. On the accounting rate of return, X and Y were equal. On this one, it looks like X is winning the day. Well, let's fill in the correct responses and see what we get. So here, 2 years, 2 years, and 1 year, and Z was the best. 0.1667 for both of those, and 0 for Z, so X and Y. 27244, 23855, and negative, they somehow round 8, 9, let's see, 8, 9, I multiplied something wrong here. Why is that a dollar off? I think this, I didn't round up on this one, did I? So that should have been 98,000 times 0.90909. Maybe I forgot the last 9. Oh, I see. So this is, it was actually 0.82. So I should have rounded this up to 89,091. And that would have gotten me 8909. Which matches. I know it's just a dollar, but you know, that's the accountant in me. I got to know why there's differences. And that's why I detest rounding. Okay. So that looks good. Now, I'm just going to say not a great problem, but it's a useful look at how we would get different answers by using different things. And therefore, we don't rely upon any particular one. Use the payback period and the accounting rate of review as a screening mechanism, and then really trust net present value to give you a better idea. Okay, let's move to the last one here. And I guess I'm going to need a new piece of paper. Now, this one is a little bit funky, and I was saying that I would prefer not to use it after I'd kind of gone through and double checked it, but that's okay. We'll go ahead and figure it out. Let me go ahead and I need to get the other table going. Okay, so let's see. This is number 15. And let's take a look at the preview of the question. It says use Excel or the equations and tables in Appendix 12A. Determine the answer for each. The future value. Now, they don't give us a future value table, so I'm going to give you, looking at what they have given us an equation, which is, 1 plus I raised, 1 over 1 plus I raised to the n times the present value. Well, okay, that is the equation, and they may want you to use that, but I'll give you an easier way to do A. So A, what I'm going to do is write out what we need to find, and then we'll go to the tables and find all those numbers. It's going to be, this is going to be future value of 3 periods of 8%, and the present value is $1,000. B is going to be present value, 5 periods, 10%, times $5,000. C is going to be present value of annuity. It's going to be 6 periods at 10% times $9,000. D is going to be, okay, so looking at D, you may be confused about what they're asking about. I'm going to tell you this is a present value of annuity question as well. because when we get there, I will show you what we're asking. But let me just put this here. This is going to be 8 periods, 12%. And I'm going to leave this blank, and I'm just going to put this in parentheses, or in print, we're looking for something 14904. Okay, we'll just leave it at that, and then when we get there, because when we do this one, this will help us understand this. When we do C, it'll help us understand D. Then E is a proposed investment will provide cash flows of 50, 10, and 7 at the end of years of 1, 2, and 3. What is the present value? So this is present value of 3 separate years. And so the first one is going to be 1P, 2 periods, 3 periods. These are all at, what's the value? 20%. Big number. And the amounts are going to be 50K, 10K, 7K, and let's see, F is going to be find the present value investment they'll pay $7,000 at the ends of years 10, 11, and 12. Okay, so we're going to look at this 2 ways. We're going to look at it again as present value of 3 separate years, 10P, 11P, and 12P, all at 12%. And all at the same amount, 7K, 7K, 7K. The other way we're going to look at it is we're going to say, remember, when we looked at present value of annuity, I didn't go through it, but actually it is just present value of annuity of 3 is the adding up 1 and 2. Present value of annuity of year 4 is adding up years 1, 2, and 3. So what I could do here is figure out the present value of 12P, and I would subtract out everything that had happened before that, the present value of annuity of 9P, and that would get us the same thing using the same 12% and 7K. And we can look at it and see how that ends up being the same. Okay, so now let's take a look at the actual tables. So we're going to go through here, and I'm going to look this number up on the present value table. Okay, so bear with me. So even though it's a future value, I'm going to look up 8%. Let's see, I'm trying to get the cursor to show. It's not going to show unless I do this. So I'm not going to get the good cursor, but at least you can see I'm looking at third period. And so it says 0.79383. Okay, so here's the little trick that if you don't have a future value table, if you're stranded on a desert island and you only have present value and present value of annuity tables. Okay, this is how you would get a future value, at least the future value, maybe not the future value of annuity. Remember, we said that the discount rate is the inverse of the compound rate. So if I think this is the discount rate, all I'd have to do is 1 over this number, which would give me the future value rate. So 1 divided by 0.79383 would be some number. Here in this case, it's 1.25, yada, 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 times 1,000. And we are, what are we rounding? It doesn't say. I'm guessing we're rounding. So this would be rounded to be 1,259.7, or I would just say 1,260. Present value of 10% fifth period is going to be 0. So this is multiply times 0.62092. So 0.62092 times 5,000 equals 30104.6. So I guess rounded it would be 3015. Present value, so C, present value of annuity. So we're going down to this table. 10% period 6 is times 4.35526 times 9,000 is 3139197. Okay. So we're now down here at this one. In fact, you know what? Let me actually just, while we're doing through them, let's fill in the correct responses and see how we're doing. Okay. So this was the thing, the second thing I was looking at. I noticed that some of the numbers were off, and this is sort of a hidden thing about this question I feel like is not good. It looks like for some of the questions, they've been using just the first 3 digits, the first 3 decimal places. So in other words, if I do 5,000 times 0.621 rounded up, right? It comes out exactly at 3105. If I do 9,000 times 4.355, 39,195, right? So when I was going through and double check, but they don't say this. They say use the table or the equation, but it doesn't come out correct. So they've done, so if your numbers are not coming out completely right, now, because these are randomized numbers, maybe your numbers come out okay. But here, you notice I did do the correct calculation and rounded correctly, but actually what they're looking for, and I don't know if they would give it to me if it's within a certain variance, but 31915, because it appears that they're truncating the actual number from the table, which is silly. Okay, so when we get to this one, I said it's a present value question, but what does it really mean? Well, the question itself said, let me bring it back up. The question itself said, an initial investment of $14,904 is to return in 8 equal payments. Rate is 12%, and it says determine the amount of each payment. Well, here, this question is, this is the payment, this is the factor, and this is the total present value. So what they're doing here is this question, even though they've asked us weirdly, is they're saying the total present value is 14,904. We've given you the numbers to figure out the factor. Tell us what the payment is, right? So if we use these numbers for the factor, let me go back and take this out. And I go, it's present value of annuity, 12%, 8 periods is 4.96764, right? So rather than the payment times this number equals this number, we're going to have to divide 14,904 by this number to get the payment. So 14,904 divided by 4.96764 equals 3,000. So the payment is going to be 3,000. And just for giggles, 14,904, if I truncated that, 4.968. Wow. I really think they are. They're cutting off the last 2 digits of the Anyway, okay, let's keep going. The proposed investment will provide cash flows. Well, here we just have to do these each one separately, and that's why it's not good. I mean, it's more work when you have unequal cash flows than when you have equal cash flows. If you have equal cash flows, the present value of annuity does some of your work for you. So here we just look up on the table 1P for 20%, which I don't know if I've done that before. That high a percentage, 0.83333. Is it 4 threes? Yeah. 20%. The next one is 0.69444. Next one is 0.57870. Okay, so 50,000 times, and I'm just gonna cut it off now. Let's see if we get the right number. 0.833 equals, wow, look at that, spot on money penny. 41,650. 10,000 times rounded up would be rounded would be 0.694. What do they give? I think that's what they're doing. It seems obvious. Now, it may not have been obvious to you, but I've done so many of these types of things that I recognize sometimes when they truncate. 7,000 times 0.579, right? 4053. Yeah, that is what they're doing. So it may not work. I mean, I'm not sure about all the different variations, but at least on this one, for whatever reason, they've done that. So here, the last one is find the present value of this situation, or could we do this situation? So if I looked at the present value number of 12P, I'm going to say 12%, 12 periods, that's going to be 6.19437 minus the present value of 9, which is 5,32825. Or I could do the present value of each of these individually. So the present value of 10 is 0.32197, 0.28748, 0. And this is why financial calculators make life easier. But it is important for you to understand what's going on behind the numbers. Well, you may not think so, but I think so. You know, if I add all those together and just multiply them by 7K, that would do it, because each of those numbers, you know, rather than 7K times this plus 7K, I can just add these numbers and multiply it once. So 0.25668 plus 0.28748 plus 0.3. Do they want us to give any of it? No, they don't. Just the total. 32197. So these numbers add up to 0.86613 times 7K is 6062.91. But what if I just did these numbers? 0.866 times 7,000 equals exactly 6062. Okay. Now, what about this situation? If I've done this correctly, this number should be this number. 6.19437 minus 5.32825. And it comes out to, because of rounding on the fifth digit, 0.86612 versus 13. 86613 versus 12. And if I had truncated times 7,000, it'd get us the same number. So you can see that how these numbers are related. So if you have a situation where a bunch of the first years don't matter and you're just looking at years 10, 11, 12, you can do it individually, or you can subtract the top number from the the number prior to the start of the series and get the same number. And so all of those work out. Okay, well, this is kind of a strange chapter to end on. I mean, there's a lot of good information. I think I would prefer this chapter to be hit earlier. At the very least, it would be nice to have this as chapter 11 and end on chapter 11, which is a bunch of kind of random stuff rather than having some sort of calculator intensive calculations here at the end. Anyway, hopefully that gets you through all the homework. If you have any questions, let me know. Good luck. And we're coming to the end of things. If you have any questions, make sure you go back and finish up all of your unfinished quizzes. Make sure you get as many points as you want on those. And as I mentioned in the D2L, on the D2L post, if you have a homework that you didn't quite finish or you wanted to do a little better on, just email me and I can reopen one of the past homeworks for you. Okay, good luck. Talk to you soon.